What's Vanguard's outlook for U.S. equity returns for 2026 and beyond? Hi, I'm Khang. Today we're digging into a key insight from the 2026 Vanguard Economic and Market Outlook, our forecast for U.S. equity returns. We'll also break down why this forecast is consistent with our view on AI's impact on the U.S. economy. For 2026, on the economic side, we're anticipating quite a bit of an upside, and the AI capex build-out will be a critical contributor and a swing factor to that view. Now, as they say, the economy is not always the stock market, and that certainly is true from our perspective. We have a much more nuanced view on U.S. equity market. For the near term, we're possibly seeing a good case for a continuation of the momentum that we've been seeing in the tech-heavy growth equity segment for the U.S. market. And that will be because it'll be based on a continuation of earnings growth. Now, when we think about the longer term, though, our prospect is not so sanguine. It actually is quite subdued. And that is because even if AI ends up being great for the economy, one should never really underestimate the power of competition and the uncertainty around the new technology that we all will be going through. Because the stock market tends to heavily overweight near-term prospect, the disconnect between the two horizons, in our view, presents a longer-term downside risk that is not really being priced in. This may be a slightly tricky point that's worth unpacking with a few scenarios. So this scenario is going to be the easiest one for folks to be able to relate to because it really reflects the market sentiment that we have been living in over the last few years. Think of a scenario where AI actually becomes transformative for not only just the corporate sector, but especially for the economy. And as a result, it ushers in trend growth rate above 2%, maybe even close to 3%. So that's going to be a great development for the economy. On top of that, the leaders that are ushering in AI technology into the economy, in a way, will be able to continue to hold on to their moat to some degree, and then continue to grow their earnings at a rate that is really phenomenal relative to the historical patterns that we've seen for the corporate sector. That leads us to earnings growth above 8+%, and then a 10-year equity return projection of anywhere between 8 to 10%, which is a great number. That's going to be the scenario where we will see that the current valuation of the U.S. stock market can be justified because we will continue to see earnings grow at a really healthy rate, and then we will have the economy to continue to really back that up and support that development. So this scenario is our baseline, and from an economic standpoint, it's really not that different from our first scenario, where IAI does usher in a trend growth rate of 2% and above, and we can anticipate at some point seeing the economy grow at 3% over a sustained period of time, which is great news for the economy. But the same may not be said for the corporate and U.S. capital market leadership. And what I mean by that is every time we've had a technological revolution and innovation of this magnitude, and there have been maybe 3 or 4 episodes over the last 130 years, every time it has happened, it actually led to a dramatic change in corporate leadership in the U.S. stock market. And the simple reason for that is competition and creative destruction. That's great for the economy, yet that may not be the best thing for the investors in the tech-heavy growth index in the U.S. stock market of today. And that is reflected in our earnings growth projection, as well as our return projection for the U.S. And this is also the same reason for us being so excited about the more value-y segment of the U.S. stock market, as well as the ex-U.S. international developed market, precisely because the market has not really priced in the prospect of AI really boosting and potentially transforming the business model of these sectors and bringing in that profitability that we all want to see. I stress this is not our baseline, but this is a key downside scenario. And then this is a key risk to think about, especially for the long term. The risk is that AI actually turns out to be not the general purpose technology, not the transformative contribution to the economy that we all are hoping for. And after all is said and done, we may look back and realize that, oh, that didn't really help us to grow at a higher rate. In that scenario, if you could just imagine with me, what you're going to see is all the other long-term trends that are emerging and then in a way duking out to shape the economy. And in the absence of a higher growth, the most likely candidate to really take charge of that is the rise of structural deficits that is tied to the aging demographics that we have been feeling and living through. And if you know where to look, it's still there, and it's actually showing up in different parts of the yield curves across different advanced economies. It's just that right now, just about everybody is focused on the upside that is coming from the AI, that we just don't feel it as much. But in the absence of AI, in the absence of productivity and higher economic growth that we are all anticipating, that's going to be the force that is front and center. And I stress that that's not a neutral environment. That's going to be an environment where we're going to see anemic growth. That just is not going to be good for revenue growth for companies. And that's the type of environment where the discount factor for all the stocks will have to be significantly higher, bringing down the valuation of all risk assets. And the risk assets that have most to lose in that environment are the current leaders of the stock market that have the most stretched valuation from a historical standpoint. So this is also an environment where even within equities, U.S. value equity as well as ex-U.S. developed markets have more resilience compared to the growth-heavy U.S. equity. "2026 will be an interesting and exciting year, filled with news about economic progress and potential becoming a reality. At the same time, as advisors, it will be an increasingly critical year to help investors to think through the ups and downs of the markets that we've seen play out in the past cycles where we've seen a technological innovation of this magnitude. Our view and expectation is that the lessons that we've learned from the past will become just as relevant as we get through this part of the AI-driven exuberance. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.